Okay. So in this part of the lecture, the second lecture, what we're going to do is talk about the aftermath of the American Revolution. So the war ends. We're deep in debt. There's a fiscal crisis, and it's really a case study of a resolution of how to resolve a fiscal crisis. And it actually even literally is a case study. There's a Harvard Business School case on the resolution of the debts after the American Revolution. It really is. So if we think about expenditures, what was spent during the war, it's sort of interesting to the accounting. The Continental government spent about $80 million to get us to fight the war. It had to make another sort of $21 million in interest payments, and it will, in 1790, assume about $18 million in state debts. The state governments will have spent about $77 million plus assumptions of continental obligations. 18 million of that will be transferred over to the continental government over in 1790, but you'll see that they're going to cover, roughly a third of the domestic costs of the government is going to be incurred by the state governments. And then France, and you want to put a fairly large error band around this calculation. This is kind of a back of the envelope calculation, so it could kind of say plus or minus maybe about 20 million on this, depending on how you want to do it. They provided us quite a bit of military support, and in particular, they provided us a naval support. We did not. The continental government didn't have a navy, and France served as a navy for the military. And that was a key. It was particularly key if you think about the Battle of Yorktown, which is the final battle of the war. The French Navy is going to keep the British troops from escaping, and also keep the British troops from being resupplied. So they're going to play a key role, but they're also going to incur expenses roughly on the same order of magnitude as the continental government. And it kind of, once you sort of see these numbers, you'll realize that both the U.S. continental government is going to go into a fiscal crisis, and the French government is going to go into a fiscal crisis. Both are going to generate different. One's going to resolve its this fiscal crisis in a peaceful way. They're going to have a second revolution that's going to be peaceful. Another is going to have a revolution that's going to be the opposite of peaceful. Yeah, be much less peaceful. But both this war, it's interesting. It's going to create radical changes for both of the winners.
Well, how would the GDP affect compared to the GDP of the continental government at the time?
That's a great question, and I'll say I don't know. In there? No. Actually, that's a great question. I should know that number, and we could know that number. One thing to point out is actually the U.S. is actually on a per capita basis. Quite wealthy relative to Europe. There's a reason why people are leaving Europe to come to the U.S., and we know that probably through records and also through letters. What's interesting is to read the letters of some of the British and the German soldiers who were sent over here to fight, and that they write back and they say, "These folks are so rich. It's such a bountiful country. They're so much better off." And some of the Hessians don't want to go back after the end of the war. They want to stay. So it's on a per capita basis. It's clear there's a fair amount of wealth. There's just a huge amount of land, and not too many folks. But in terms of aggregate GDP, which is what you want to know, I don't know how those compare. Tom's sworn off speaking, but he might know. So we'll get back to you. So after the 1780s, after the Revolutionary War, the U.S. is in many ways a fiscal basket case. The paper currency is depreciated to pennies on the dollar. The official default was 40 to 1, so it's 2.5 cents for every $1 that was originally promised. Massive default. These debts, all of these IOUs, Many of them are being sold to speculators, and we know that there are these advertisements in the newspapers that say, come to my storefront in Philadelphia or in a major city. I'm willing to buy and sell these various certificates, and they'll give the prices. And when you look at the prices for these various securities, they're roughly about 20 cents on the dollar. It's very much distressed debt, very much distressed debt. The continental dollar has no reliable source of revenue. There's no Army or Navy worth mentioning at this point. The Army there was never really a Navy. The Army has now disbanded. You no longer have the protection of the British Army and the British Navy. They've all packed up and left. And in particular, you no longer have the protection of the British Navy on the high seas to protect U.S. shipping. Congress doesn't have the funding to pay even its soldiers. And let me just touch back on this Newburgh conspiracy. There's a real threat here at this point, without any funding, that things could have. There are various sort of pivot points in U.S. history, and there's a point where it wasn't obvious that we were going to retain civilian control of the government during this crisis. This crisis could have been resolved in a very, very different way. If you think about it, it's there. Foreign officers are so destitute they can't afford the trip home, and we have initially there's no banks and there's no functioning capital markets. There's simply storefronts willing to buy and sell these IOUs, okay, which many people then sell because they're destitute. Now, to resolve the fiscal crisis, you have to think about which promises are you going to break. Essentially, you've promised more. You've promised more than you've got the revenue to spend. Okay, and so there's going to be sort of two components to a successful fiscal resolution to a fiscal crisis. One is sort of reworking of the Constitution in order to secure revenue for the central government, for the continental government, which is then going to become the federal government. And then a rearrangement of the fiscal authorities, and there's going to be a bailout of the states. Essentially, what there's going to do is there's going to be a deal where revenue is going to get, the sources of revenue are going to be transferred from the states to the central government, and in exchange, the central government will assume some of the state debts. Having said that, there's no, this could have been resolved in the opposite direction as well, as we want to think. There's going to be some similarities between Europe today and the U.S. then. Tom's got his Nobel lecture. It sort of centers on this, that you have a central government that's relatively weak. The main power to tax and the power of the purse resides at the state level. And you have a very, very weak central government that has lots of commitments and promises, but no revenue to back those.
Can I ask you a question?
Sure.
Like before you told us that the states were like paying some federal government debt, and now it's the opposite. It's the other way around.
Yes, that's the way it's going to get resolved.
Okay.
Yes, but there's this. That's going to be sort of a key part of the drama during this decade, is who's going to take on, and this is going to be who becomes the dominant government. Is the dominant government going to be the states? I'm sorry, what?
Who's bailing out who? Like who's?
Yeah, who's bailing out who is going to be the central issue. And basically, those with the revenue and those with the power of the purse will bail out the other government. But whoever has the power of the purse will become the dominant government. So will the states be dominant over the central government, much like the way Europe is today? Or will the central government be dominant over the states, which is what we have today in the U.S.? This is going to happen. There's going to be the first round of this is going to happen in 1790, and then there's going to be various other episodes that's going to strengthen the federal throughout the history. That's going to strengthen the federal government relative to the states at various times. So again, there was this consolidation of the debt that occurred, Robert Morris, and part of this is to sort of try to create a liquid set of securities. They're going to be unable to make interest payments, and there's going to be the foreign debt as well. okay, which we talked about. Now, if you just look at the interest-bearing part of the debt, this doesn't include this is just the interest-bearing part of the debt, does not include the continental dollar, the non-interest-bearing part of the debt, the money. This is just the interest-bearing part of the debt. What you'll see, actually, I wish I'd done this graph slightly differently so that you could see, you could kind of split out the domestic debt and the foreign debt. But you kind of see that, again, the foreign debt is a relatively small amount of the total portion of the debt. It's this green. And then there's kind of equal portions of the loan. There's these loan office certificates. There's the Army debt. There's these additional liquidated debt certificates. Some of these liquidated debt certificates are going to get refinanced into something called registered debt. And you'll see that these obligations go up as they go onto the books. They start to go onto the books starting in 1780, and then they start going in 1781, 1782 as these things start to get recorded. And they start to go onto the books of the U.S. Well, I should just note with the Army debt, by 1780, the government recognizes that they owe this Army debt, but they haven't actually issued these certificates yet. But they do start to record it on the books, that they know that they're on the hook for this stuff. But they just start reporting estimates of what they owe. They don't. It's not until later years so a couple of years later that they actually start writing these certificates. But then what you can see is that you can see that this accrued domestic interest, as the interest payments aren't getting made, it's starting to climb and starting to climb and starting to climb. And so by the time 1790 rolls around, they owe about $55 million in domestic debt, and it starts to build. Let me also just note that at the time, people perceived a distinction between the loan office debt and the other domestic debts. And there was a thought that the loan office debt was generally seen as higher quality and traded at slightly higher prices than these Army debts, these what were called Pierce certificates after the Paymaster General Pierce. They were seen as higher quality than the Pierce certificates or these liquidated debt certificates, and particularly much higher than the unpaid interest. A higher quality. They traded it. There was perceived sort of three tiers. There was sort of the loan office debt was considered high quality, Army debt and liquidated debt certificates were kind of medium quality, and the interest on the debt was considered extremely low quality. So the differences are like 25 cents on the dollar, 20 cents on the dollar, 15 cents on the dollar in terms of what these things traded. Very slight differences. But these were perceptions there. Now, during this period, the organizing principle for the government is the Articles of Confederation. And when I teach this class to undergraduates, or I teach a version of this class, a very different version of this class to undergraduates. No dynamic programming there, but you mentioned the Articles of Confederation, and it's a lot of American students, and they all go groan. They've been forced to learn the Articles of Confederation. It's perceived as the most boring of topics, but actually it's quite fascinating, and I think it's worth. Well, I thought it was boring when I had to learn it as a high school kid, and then had to relearn it again as a college student, and now I think looking at so we've had two constitutions in the United States. We've had the Articles of Confederation, we have the U.S. Constitution. Both are relatively short documents. They're not that hard to read. They take about, they don't take a long time to read. They're actually worth reading in terms of and reading both through and thinking about, here's one way to organize a government, and here's another way to organize a government. And they've been models for various other governments out there that had particularly the U.S. Constitution is a model, and it's actually quite striking what's in there and what's not in there in these documents in there, and so they're worth the. I encourage you to read them. They don't take long, and they're interesting documents. So it was originally written in 1777, and it took a while for it to be adopted, and it went into force in 1781. So essentially at the end of the war. So the fighting ends in 1781 at Yorktown, and the United States is governed by these Articles of Confederation. It's essentially a treaty, way to think about it, associating 13 sovereign states with a very weak central government. And what's going to be key when we look at it is the Confederation government has no power to tax. It can only ask the states for contributions. The main taxing source or powers, both tariffs and tariffs are the mother lode of data at the time. That's the real mother lode of data, are tariffs. When the ships come into the harbor, you've got an obvious time you can tax them. They belong to the 13 states. But what we'll see is that while the central government doesn't have the power to tax, it's obligated to pay its debts. And they can incur debts, and they can incur it in lots of different ways. They have these loan officer certificates, quartermaster certificates, and IOUs to the Army. Okay? Lots of different types of debts. Okay? And it's worth going through. Dewey, in Dewey's book, walks through some of the key articles that have to do with the fiscal arrangements of the Articles of Confederation. It's worth reading through some of these. So in Article 8, all charges of war and all other expenses that shall be incurred for the common defense or general welfare. And notice this phrase, common defense or general welfare, is going to carry on into the U.S. Constitution. And that's going to be a key. How to define those words is going to be central to thinking about the size of the government, whether how open-ended is common defense and general welfare. Okay, so common defense, general welfare, and allowed by the United States and Congress assembled, shall be defrayed out of a common treasury. So it's going to be a common pot of money, which shall be supplied by the several states. And then notice this, in proportion to the value of all the land within each state. So the idea is they're going to go to each one of these states, they're going to total up the value of the land, and that's how much each state is going to have to kick in. So think about how hard that's going to be able to calculate. Like, what's the value of the land of Massachusetts? What's the value of the land in New York? And then you're going to have to argue about that. That's how much each person's going to have to kick into the common kitty, into the common pot. Okay, granted or surveyed for any person, such as land and buildings and improvements. So not only the land, but they're going to have to assess the buildings as well. Shall be estimated according to such as a mode as the United States and Congress assembled shall from time to time direct and appoint. From time to time. When they go and do this assessment, from time to time. Taxes for paying that proportion shall be laid and levied by the authority and direction of the legislatures of the several states. So it's going to be, the assessments are going to be based on the value of the land and property within each state, and the payments to the central government are going to come from the legislatures, not from individuals. So the legislature imposes the tax on the individuals and then makes the payment to the central government. In that part, it's like Europe today. Okay. So everybody lumps everything into these common charges and these common expenses. And then if a state pays more than its share, it receives a credit. And if it's less than its share, it receives a debit. And, everybody sort of says, here's what I contributed to the war. Congress has this problem of saying, well, these are expenses we didn't necessarily authorize. There's this debate about who paid what where. Do you have the records? No, we don't have the records. It was a war. And there's lots of fighting about who's doing, the southern states don't keep as good of records as the northern states. Just kind of not terribly shocking. But there's kind of this about, I kind of think about it like, like living in a house with a bunch of college buddies or something. Everybody kicks in a certain, how much everybody owes to go, buy supplies for a party or something like that. Everybody kicks into a common kitty. It's like everyone's going to kick into a common pot. And so, if you, there's going to be these big debates about who, it's very vague how much each state owes and whether you get credit for expenses that you did for a national cause. Also, just what is the value of the it's just going to be assessed based on the value of your landed property. It's just going to be very hard to tell on that. Other provision, number 9, United States in Congress assembled shall never engage in a war. Notice these are all negatives. It's interesting. Never engage in a war, never grant letters of marque or reprisal, never enter into any treaties or alliances, nor coin money, note this phrase, coin money, nor regulate the value thereof, nor ascertain the sums or expenses necessary for the defense and welfare of the United States or any of them, nor emit bills, nor borrow money on the credit of the United States, nor appropriate money, nor agree upon the number of vessels of war to be built or purchased, or the number of lands or sea forces to be raised, nor appoint a commander-in-chief of the Army and Navy, unless 9 states assent to the same. And you quickly see it's 9 states. You start with 13 states, but there's going to be, what happens when we admit new states? It's fixed at 9, which is interesting. Nor shall a question of any point except for the adjourning from day to day be determined unless the votes of a majority of the United States in Congress is assembled. So you need a majority assembled to do anything, and you need to get the votes of 9 states to do something, which is going to be, you need a supermajority, and it's 1 state, 1 vote. Okay, so Rhode Island has as much vote, which is a small state, relative to, say, a big state like Virginia at the time. All bills of credit, money borrowed, debts contracted, or under the authority of Congress before they assembled and pursuant of the present Confederation shall be deemed and considered as charges against the United States for payment and satisfaction, whereof the said United States and the public faith are hereby solemnly pledged. So the central government's on the hook for all its debts. It can ask for requisitions from the states, but it can't force the states to pay. Okay, so it asks for contributions from the legislature to pay these debts, but it doesn't have any revenue itself. It can only ask state governments to contribute money, but it's on the hook for all its debts. So, like Dewey points out, the omissions in the he calls it a curious arrangement. He calls it, and he says the omissions are more important than the provisions, which is exactly right. They have the authority to incur debts, but not the authority to service them. It's from what resources, when Congress, if you're owed money by the Continental Congress, by the Continental government, and you're sitting here being told the Continental Congress can't pay, well, it's only natural that you're going to go to the state governments because the Continental government doesn't have any source of revenue to pay you back. It's going to be the state governments. And if you think about it, the state governments, why would they want to pay back? If they think about it from the point of view of the state governments say, well, we can either pay, I can either make sure that the debtors, the government creditors in my state get paid, or I contribute to I can either spend money paying off and incurring, assuming debt of the Continental government, which I'll take a credit for, and pay off my own citizens, or I can send money to the central government in Philadelphia, in which they're going to pay off the creditors from other states. So I'd rather assume the debts of my own citizens, and then claim a credit. So when the Continental government says, here's how much we owe, we say, well, I've already paid off this much, and I paid it off to my own citizens. You can quickly see that. So as we've talked about here, they owe, during this period, they owe, up to $2 million in interest payments each year, and they're paying a mere fraction of that. Meanwhile, the debt is accumulating steadily. And it's doing it through this accumulation of unpaid interest. You see, the principal isn't changing a lot, but the unpaid interest is starting to pile up and pile up and pile up and pile up. Okay. So bang, you've got a fiscal crisis. States are declining to send enough revenue to the Continental Congress to make any of these payments. And then they're not being able to make any payments. They can't fund an army and a navy. They can't make promised pension payments. Further, what's going to exacerbate this problem is the tax is again the mother lode of revenue are the customs revenue, and it's not too hard to realize that if you're a shipper and you're thinking about what port to land in, you're going to ask states, well, what's the tax rate I'm going to face? And Rhode Island is going to drive Connecticut and Massachusetts crazy, because Rhode Island will, for example, always promise to give a better deal than if you unload it in Rhode Island, you'll get a better deal than if you unload in Connecticut or unload in Massachusetts. And Massachusetts and Connecticut are going to get upset about this, that they always feel that they're getting undercut. So you've got these states competing with each other, and foreign shippers are more than happy to play one state off to the other to try to reduce the revenue. Consequently, the domestic debt is trading, roughly at about 20%, 20 cents on the dollar. And you have this big distinction between what's the part, when you say what's the value of the U.S. debt, is it 55 million in domestic debt, or really more closer to like $10 million? The market value of the debt is much closer to about 10 million. And so in that government budget constraint that we write down when we say what's the market value of the debt, you want to think 10 million. Though what's on the books is 55 million. It's basically 55 million. So there's this sharp distinction about what the market value is and the par value is. So now the question is, what's going to happen to all these obligations? And there's going to be various views on this, on what's going to be important. So actually, even before, so Robert Morris is trying to review all these claims and going to try to settle all these claims. But even before he can settle them, the states are already starting to assume continental obligations, that people they have obligations from the continental government, and the states are starting to say, oh, we'll take those and we'll own those ourselves, okay? And while it's difficult, again, some of these records were destroyed in the 1790s, we think that roughly about $60 million were destroyed by the states. And this was very much alarming to people who want, such as Robert Morris and Alexander Hamilton, who were worried that this was going to lead to a very weak central government and strong state governments. So let's think about it. So in the 1780s, the Continental Congress had large outstanding debts, no authority to tax. Continental Congress is paying 10 to 20 cents on the dollar, and you're just thinking about yourself as a continental creditor. What are you going to do? Basically, there's little hope of ever getting it paid by the Continental Congress. So you think, okay, well, one plan that had a lot of political support was you've got the states, they've got the taxing revenue, they've got the power to tax, therefore they should assume the Confederation debts and they can pay off the Confederation debts that are owed to their own citizens. The states like this, they make sure their own citizens get paid, as opposed to throwing into the common pot where those payments are going to go to everyone else. And it means that the states are going to have the power to pay their own debts, and the Confederation debts of their own citizens. And you start to see this getting implemented. Rhode Island starts to implement it. Pennsylvania starts to implement it. And you start to see these debts getting assumed, and then doing that as well. Another plan, which is going to be called the Nationalist Plan, Ferguson, well-known historian, is going to call this the Nationalist Plan, is going to be that what needs to occur, and this is Robert Morris starts to express this view in the early 1780s, and formulates this view, and ultimately it's going to be carried out by his successor, Alexander Hamilton, which is the Confederation government needs to obtain the power to tax. We need a national tax. And then once we have a national tax, then we will nationalize we'll pay back both the continental debt and we will assume the state debts. And this will, this is going to move the power and move people's move people's political interests and move the center of power away from the state governments to the federal government or to the central government. And essentially what it is think about if you're owed money by a government, then you want that government to succeed and you want that government to be strong because you want to be repaid. If the states owe you the money, then you're going to want the states to be well funded and to be strong. And your interests are going to be aligned with the state governments. What Robert Morris and then later Alexander Hamilton wants to do is to assume those debts and align the phrases that they want to align the interest of the moneyed men with the federal government. So that the moneyed men, their interests, their own personal interests, are with a strong central government that is well funded and robust and will then be repaid. Can then be repaid. And so the question is, this is going to be key because there's still a large split. And this split is going to carry on in some sense that you see it even to this day about what the relative power of the state should be relative to the central government, to the federal government. It's going to generate a civil war, by the 1860s, this debate. And it plays a key role here. And it's going to be, they made a hit musical out of this whole thing. I mean, it's really quite amazing. Yeah. So both have the underlying logic. The authority to tax, now and later, gives that part of the government the power to service the debt. And the responsibility of servicing debt requires the power to tax. And to get this sort of bailout, it's going to require a constitutional quid pro quo. You assume the debts, but you also gain the power to tax is there to do it. There was an attempt to do it in the early 1780s. So Robert Morris proposed to have a federal tax, or a tax going to the continental government, to the Confederation government. It would have required an amendment to the Articles of Confederation, and it gets blocked by Rhode Island. Rhode Island's it's a small state with a big port, and it is doing quite well under the Articles of Confederation and has no great desire to give that up. It creates that. So the plan to get national revenue, that ultimately fails. It gets held up by Rhode Island. So then in the intervening years, states start to assume Confederation IOUs, and they start exchanging them for state bonds and raising current and future taxes enough to service them. Robert Morris does everything in his power to try to stop this, but it only has limited authority. But he very much tries to stop the states from assuming continental debt. So what happens is the nationalists decide we need to, the problem is, trying to amend the Articles of Confederation, that's not going to work. What we need to ultimately do is tear up the Articles of Confederation and write a new constitution. And so that's going to happen in the summer of 1787 in Philadelphia. It starts off as a convention it's sort of promised as a convention to revise the Articles of Confederation, partly to allow revenue, but also to try to facilitate. There's a recognition both they need to raise revenue partly to pay off the debt, and also they need to raise revenue in order to do some internal improvements, in order to build canals and roads that are going to cross state lines, and how to do that. That's part of what they're going to discuss on that. It ends up quickly turning from a constitution to revise the Articles of Confederation to simply rip it up and start anew. Okay. It gets adopted at the end of the summer in 1787, and there's a long and fierce battle for ratification. That eventually happens in 1788, and it goes into effect March 4th of 1789. Okay. It's going to be the fiscal frame. It's now the fiscal framework of the United States, and many of the fiscal debates today, and back then and today, are about. I don't know how that typo occurred. You know, how to interpret these phrases. And again, the Constitution, it's not that long. Once you sort of read it, I mean, it really, you're used to all these like pontificating, politicians who say, "Oh, I keep a copy of the Constitution in my, right breast pocket." You really can. It's just not that long, big a document, and it's not that hard to long a document, and it's worth reading. It's actually quite interesting. But you'll see some key changes. You see a lot of similarities between the Articles of Confederation and the Constitution, but then you see really, when you read them side by next to each other, you see the key differences. So one is that in terms of revenue, you'll see representatives and direct taxes shall be apportioned among the several states. They no longer mention numbers on states. They now realize they're going to start to increase the number of states, which may be included within the Union. So, however many states they're going to be, they're seeing they're going to grow according to the respective numbers. And so no longer is it value of land. They're going to do it based on population, which is much easier to count. Now, of course, what's sort of going to get changed here, or later will get changed, and this is kind of odious here, is you quickly see, shall be determined by adding a whole number of free persons, including those bound to service for terms of years. So those are indentured servants. So you've got indentured servants back then, and excluding Indians. So Indians don't count, not taxed. And then 3/5 of all other persons. Who are those all other persons? Those are slaves, which is quite so. So slaves count as 3/4 of the person initially in the Constitution. It is not something to be proud of there. It's going to have a funny feature in that it's going to, because African Americans are going to be prominently, are a huge portion of the population in the U.S. South. So it's going to, what's interesting in this is it says both taxes and representation are going to be apportioned by population. So it means the South pays fewer in taxes, but it also gets less representation because of this 3/5. Once that 3/5 rule is going to get removed by the 14th Amendment of the Constitution, they're going to rewrite this paragraph as part of the 14th Amendment, right after the U.S. Civil War. That's going to have the effect of increasing the representation by the U.S. South on that. So it's going to have, and it's going to increase the power of white voters because they're going to effectively disenfranchise freed blacks during that period. So it's interesting. But the point we want to make here today, the main point, besides acknowledging this sort of dark blot in U.S. history, is that now taxes are going to be imposed based on the population, not on the value of land. It's just going to make it much easier to collect revenue. Spending is going to reside with Congress and the legislature. So one of the key things in the United States, so there's 3 branches of government. There's the executive, the legislative, and the judicial. Spending resides in the legislature. And the legislature has the sole power to tax, spend, and borrow. And all taxing revenue, taxing revenue has to come out of the House of Representatives or from the people. Okay? So it's the Congress that shall have the power to lay and collect taxes, duties, imposts, and excises, to pay the debts and provide, again, we see this phrase, common defense and general welfare. But all duties, imposts, and excises have to be uniform across the United States. You can't charge different groups of the United States different taxes. Congress has the sole authority to borrow money on the credit of the United States, to regulate commerce with foreign nations and among the several states and Indian tribes. And then here's another phrase that's worth remembering. They have the power to coin money, regulate the value thereof and of foreign coins, and fix the standards of weights and measures. Now the phrase is to coin money. What's the verb to coin mean? And the question is, when you see these green pieces of paper, is this coining money? So just kind of put that out there, and then they can punish counterfeiters. And you'll note that what's of interest is that what you'll see that they don't mention anything about bills of credit or fiat money. The Constitution doesn't say you can't do it, but they also don't give the power explicitly to Congress, but they don't rule it out. But look at what they say about the states, which is quite different. We'll do that in just a second. So these are the limits on Congress, and we'll get to the states in a second. So no or direct taxes shall be laid unless in proportion to the census or enumeration herein or there before directed to be taken. No tax or duty shall be laid on articles exported from any state. You can't tax things exported from a state. No preference shall be given by any regulation of commerce or revenue to the ports of one state over those of another, nor shall vessels bound to or from one state be obliged to enter, clear, or pay duties to another. And no money is drawn from the Treasury, but in consequence of appropriations by law and a regular statement of accounts. So you've got Congress has to authorize any money to be drawn out of the Treasury, and you've got to make a statement of receipts and expenditures. Okay. So Congress is assigned the power to tax and borrow with very few limitations. And this phrase, common defense and general welfare, is going to be interpreted broader and broader and broader and broader and broader. And what Congress can spend on, for common defense and general welfare, it really doesn't preclude much of anything. It's hard to argue that something's not for the general welfare of that. Now, there's some various limitations. Taxes have to be uniform across the state. And there's going to be a big discussion about what is a direct tax? What does it mean? Like the phrase direct tax, there's going to be some debates about what a direct tax is. Was it a poll tax? And in particular, is an income tax, is that a direct tax or a direct tax or an indirect tax? So what does that mean? And direct taxes had to be in proportion to the population. Sounds a lot like a poll tax or requisition. So this is going to end up getting clarified about the question about whether the income tax is a direct tax or not. There's going to be a debate on that. And so, that's going to take an amendment to the U.S. Constitution to clarify whether an income tax is a direct tax or not. And so they're going to then say, they're going to take the 16th Amendment where they're going to say the Congress shall have the power to lay and collect taxes on incomes from whatever source derived without appointment among the several states and without regard to any census or enumeration. So, and again, this common defense or general welfare is going to quickly become an extremely broad thing about what we can spend money on. But it's going to come into, we were talking earlier, Jonathan, about the Louisiana Purchase and whether it was constitutional. Is buying the Louisiana Purchase part of the general welfare of the United States? Sure, why not? It was a good deal, so why not? Now, contrast this power is prohibited by the states with what gets mentioned with the powers given to the Congress. So no state can enter any treaty, alliance, or confederation, grant letters of marque or reprisal. Okay, so that looks a lot like the Articles of Confederation. But then they say it can't coin money. Only Congress can coin money. So the states can't issue money. And But states can issue bonds, and states can issue things that look like IOUs, and often issue things that look like script, which you sometimes wonder. But then here's the thing, they say, cannot emit bills of credit. So it's explicit that states can't issue fiat money. Okay? It can't coin money and it can't do fiat money. There's nothing about bills of credit where it comes to the Congress on that. Make anything but gold or silver coin a tender in payment of debts. Pass any bills of attainder, ex post facto law, boom, boom, boom. And so states can't issue money, and they can't make anything legal tender except gold or silver. So they can't do that. Congress, though, doesn't rule out bills of credit. And then this actually is sort of interesting. This is partly due to a desire. This is southern states worried that the northern states are going to put pressure on slavery. This gets added. No state shall, without the consent of Congress, lay any imposts or duties on imports or exports, except what may be absolutely necessary for executing its inspection laws, that only the federal government can regulate interstate commerce. And this is, they're worried that the northern states are going to make it difficult to sell goods that are produced with slavery. There. So states can't issue money, and they can't impose tariffs or customs duties. Okay? That is going to go to the federal government. Okay? They can't do it. Okay? So they take over there. Again, all debts, contracted engagements entered into before the adoption of this Constitution shall be valid against the United States under this Constitution as under the Confederation. So it's in the Constitution that they're on the hook for all the debts up to this point. We're almost out of time. Let me just point out this. Let me just throw out one thing, and it'll be sort of a topic to think about. So the question is, so the U.S. Constitution was a move to add. It was created by the elites. Okay, it's not like it was in a constitutional convention by the elites of America, the elites within the United States. And then the question, one of the classic sort of questions in U.S. history is, what were their motives? Why did they want to do it? Were they good, honest men who just wanted the best for America? There's an alternative. So that's sort of the popular notion that they were good, honest men. A very provocative claim, or very provocative thesis, was put out basically a century ago by Charles Beard, who went on to found the New School. Here, he was president of the New School. And he says, look at these guys were a bunch of rich guys who were owed a lot of money and wanted to get repaid. They weren't acting in the national interest. They were acting in their own interest. And it's just something to think about for now, and we'll talk more about that when we reconvene either in a week. We might go back to doing some theory, or we might go back and do some history. But we'll take it up there next time. So thanks so much.